Hello everyone, it's Professor Reiko here. Today we are going to look at operating leases, and I pulled a problem from the Wiley book, from the Kiso book, and we'll look at the lessee and the lessor. All right. So remember, if it doesn't satisfy one of the 5 criteria that's listed out in the first video for leases, then it's going to be an operating lease. However, it's similar in that the lessee is going to record the right of use asset and the lease liability at the beginning of the lease. All right, and they're going to do that using the present value, like we'll still, so that will be similar. They're going to still use the effective interest method to amortize the lease liability, but now interest is reported as part of lease expense instead of interest expense. And there's no amortization expense that's reported. Instead, where you're going to plug in the amount that increases lease expense, that will be the same amount each period, basically matching the payment. All right, so that sounds like a lot. We're still essentially going to have amortization expense and interest expense. We're just going to call them lease expense. So basically, if you think about it this way, lease expense equals interest expense plus amortization expense. So we're just going to call everything lease expense. Now, the Spiceland book still calls things interest expense and amortization expense. They get the numbers the same way, but you can see, but even in the Spiceland book, they, in the reading of it, yes, you can actually read a textbook. In the reading of it, they say that lease expense is, the interest expense plus the amortization expense equals the lease expense. So they say it at a couple different places when they're talking about operating leases. So it's the same thing presented just a little bit differently. I'm going to follow the Kiso book and then show you what the Wiley book does. So the main difference, though, is that amortization expense is not done over the straight line basis like it was done for the finance leases. So that's our main difference here. All right, so let's look at this problem. Like I said, I pulled this from the Kiso book. So on January 1st, 2017, the machine was purchased for $900,000 by Young Company. It's expected to have an 8-year life with no salvage value. It's depreciated on a straight line basis. All right, the lease term is 3 years, so clearly it doesn't satisfy the 75% rule because 3 divided by 8 is not 75%. Annual rental payments of $159.55 at the beginning of each year. The machine is expected to have a residual value at the end of the lease term of $562.5, though it's unguaranteed, which means the lessee does not care. Record the journal entries they record on this, assuming its incremental borrowing rate is 6, and we do not know the implicit rate. All right, so a couple of things here. First thing we need to do is calculate the present value. All right, so if we look at this, the present value, I'm going to just do it over here. We got payment is going to be negative $150,955. So once again, I put numbers in as they are a cash flow to me. The future value is 0. Now look, there's a residual value, but it's not guaranteed, so I don't care about it as the lessee. Number of periods is 3. The rate is 6. So the present value works out to be $427,714. All right. So once again, the 90% rule, this number compared up here to the $900,000 fair market value, you can see that does not satisfy the 90% rule. So none of the criteria have been met. So it's an operating lease. All right, but we still calculate the lease liability the exact same way, all right, by calculating this present value. All right, and then we still set up our table the exact same way. All right, the first day there's no interest, all right, so that means every bit of it goes to reduce the lease liability, so that brings us down to $276,759. We then reduce the liability. We then calculate interest on that. 6% of the 276 number will be 16,606. Meaning we'll reduce the liability by 134,349. That brings us down to 142,210, and then we take the interest on that, which is 85,45, and 142,210, bringing that to 0. All right, so we should be pretty comfortable with amortization tables by now. All right, so this next table is the way the Kiso book presents the lease expense. All right, so notice this isn't our amortization. This is our determination of lease expense. Now remember, we said lease expense is going to be interest. So remember, lease expense, I wrote it up at the top. Lease expense equals interest plus amortization, right? So we're going to try. So we already know the interest number, because the interest number, I'm going to draw a line, are those numbers up there. The amortization, remember, is going to be our plug number. And this account's just keeping up with the balance of the RUA. All right, so the lease expense, we want to, if you look at the top there, let's just scroll back up so we can read it. All right, so we're going to plug in an amount that increases, we're going to plug in an amount that increases lease expense, so that will be the same amount each period. All right, so what we're going to want is basically we're taking the sum of these three numbers and divided by 3, which makes it 159.55. So that means lease expense each year. So notice, hang on a second. Sorry about that. I hit the, keep doing it. Keep hitting the button that turns it into an eraser. All right, so we're going to have 159.55 that we're going to lease expense each year. So notice, all right, so a couple things. Notice the dates here, and then notice here, you know, this is the first day of the lease. So we're saying, all right, our RUA on this day is 427,714. But now what we're doing is we're figuring out what's the number is going to be at the end of each year. All right, so 12/31/17 is essentially the same as 1/1/18 up here. So my interest for that year, remember, because we would accrue that interest on 12/31/17, and then that means this number is just the plug to make that balance, 134,349. Okay, so that brings the RUA down to 293,365. All right, we'll do that again. We're pulling the 85.45 number down, and then that would make this 142,210, bringing this down to 150,955. And then remember, our last period, there's no interest for that last year, because remember, we're going to make our last payment at the beginning of 2019, which means my lease liability here is 0 at the beginning. Therefore, there's no interest accrued on this $0 number during 2019. Notice this date right here is the end of 2019. So this would be 0 here, which means all of it would go as part of the amortization number, and that would zero that out at the end. Okay, so that means up here we have our lease liability at 0 at the end, and our asset is 0 at the end. Both are what we want to see happen. All right, so let's flip over to this next page here, and let's walk through some journal entries using these numbers. All right, so if we start up here at the top, all right, so this is the journal entries for the lessee. All right, so we're going to first journal entry, and so notice this is going to look just like what we did with the finance leases, 427,714, 427,714. So there's a lot of similarities, all right, between operating and the finance leases for the lessee. All right, so these journal entries look identical to what we did in a prior video when we were doing the lessee and the finance lease. All right, so here at 12/31, now remember we're accruing interest, but we're putting everything as lease expense. Okay, so that's 150,955, and then we'd have lease liability for 16,606, and then the RUA is getting reduced by the 134,349. Okay, and then the next day we pay it, so the lease liability and cash comes off the books at 150,955. All right, so the way that the way that the Spiceland book is going to do it, they're still going to have interest expense and accruing the liability for 16,606, accruing interest, I should say. And then they still do amortization expense and RUA for 134,349. All right, so if you look at that, that's obviously different than what I have here. The lease liability and RUA numbers are the same. But remember what we said on the previous page. Lease expense equals interest expense plus amortization expense. So it's still basically getting you to the same point. Okay, it just depends on what book you're using, how they want to work it out. I mean, even though the Spiceland book does this over here, that's Spiceland. even though they do it that way, they still say that, interest expense plus amortization expense equals lease expense. So technically we're doing the same thing. All right, at the end of the lease, all right, we're just going to have our last little bit of lease expense for the last bit of the amortization. Remember, that was the last plug number. All right, at this point, the RUA is now 0. Now remember, the lease liability was 0 on the beginning of 2019, 1/1/19. That's when we would have made the final journal entry for our final payment. All right, so for the lessor, real quick. So now, so looking up here at the lessee, there's a lot of similarities here. Down at the lessor, it's a lot different. All right, so all they're going to do is they're going to say when they receive cash, 150,955. Because remember, they're not getting rid of the asset. The asset is still on their books. All right, because it's not a finance lease, and they call this unearned lease revenue. All right, so remember, unearned revenue is a liability. The Spiceland book calls this deferred lease revenue. All right, same thing, deferred, unearned, both are good. All right, and then when they accrue the revenue at the end of the period, when they actually recognize the revenue, I'm sorry, not accrue the revenue, when they actually recognize the revenue, they're going to take off the unearned lease revenue for the 150,955 and recognize lease revenue, 150,955. So this is a lot different than finance leases for the lessor, but definitely easy. All right, we receive our cash payment at the beginning, record a liability, take the liability off the books at the end of the period, and record the revenue. In addition, though, since they never got rid of the asset, they have to recognize depreciation expense and accumulated depreciation on the assets. Remember, this one, it said it was $900,000 and it had an 8-year economic life. So they are also doing this every year because they still have the asset on the books. All right. So this is an operating lease, so it's definitely different. You see a lot of similarities on the lessee side, not so much on the lessor side. So just another dimension to this chapter that makes it difficult is making sure you can work through these operating leases. So make sure you kind of understand the criteria, because remember, this one didn't meet any of the 5 criteria, which made it an operating lease. And so we attacked it a little bit differently. The main difference on the lessee side is being that amortization expense, how that number, it's not, we don't do that straight line. We do that by essentially plugging that number in on the table on the previous page. All right, so there's a lot going on in this problem. So make sure you can kind of review it come test time and, really try to get comfortable with the terminology because it's just another dimension to this chapter that makes it difficult. All right, so tune in next time. Hope you're enjoying it. Please subscribe to the channel. It does help me out. And I'll see you next time when we start adding in residual values to our problems.